All right. I am here with Ben Faw, the co-founder and CEO of Advon Commerce and a partner at Dynamism Capital. How's it going, Ben?
Great, Steve. Great to be here.
Yeah, I'm excited to dig in here. We got a lot to discuss. Multiple different types of transactions taking place, multiple different exits. But before we get into it, let's talk about your background. How'd you get started in business and entrepreneurship?
Yeah, thanks, Steve. The first venture was probably trying to sell some bottle caps just to make money for probably baseball cards, circa age 5, and it was kind of the linchpin or leading effort of many different small business ventures, from mowing lawns to selling gourds. After undergraduate West Point and service in the Army, the next kind of dive back was actually a stint in investment banking at UBS in New York, followed by Tesla Motors, followed by business school. And then after a stint at LinkedIn, I was back in pure entrepreneurship startup mode with Best Reviews.
Very cool. Very cool. And it's a great kind of segue into best reviews. I guess what's the starting story there? Did you get a co-founder? Did you raise money? How did that begin with best reviews?
Yeah, it's a really interesting story. I actually met my eventual co-founder, Momshil, of the three co-founders at an admitted student event for Harvard Business School. He was at Google at the time. I was at Tesla. Neither of us knew each other, and we didn't, frankly, know a ton of the people going to the school. But we met at this event in the Bay Area where we both resided at the time, and then when we ended up in Boston together, we continued to connect pretty much every week. We didn't really take classes together, but we talked about different startup ideas, different business ideas, and it was actually during our last semester that we were, of the many things we'd done together, we worked on this, reviews idea with our third co-founder. And the real backstory there was the third co-founder had this pain point of going to purchase a cordless drill and one of those battery powered drills, and just felt like there weren't good options to help him get a good purchase made with the available online sites. And so his thesis was, back in the even 70s and 80s, 90s, perhaps people would use Consumer Reports, buy that, you know, literal print magazine. But his view was which we shared, was the digital world hadn't really filled in the space for a new model there. And so we thought there might be a gap. And so we just kept plugging away and finally started to get some traction circa April, May of 2014. And that was right there in the Harvard Innovation Lab.
Very cool. Very cool. Yeah. Before we started recording, we were talking about uh, the whole Cambridge area and the iLab and just Harvard in general. Me having spent some time there early on in my entrepreneurial journey, and it is a very special place. Very vibrant. A lot of good ideas. It's probably the one of the only places on the East Coast, I think, where similarly in Silicon Valley, where you can say, I'm going to shoot rockets to Mars, people will not look at you too crazy there. They'll say like, all right, cool. Like that sounds good. Many other places that can't really be talked about. But I admire that place for sure. So let's talk about the team. You had two other co-founders. There was three of you. How big did the team get over the course of the business's period while you were growing into the exit?
Yeah, so I think we were pretty much at our maximum size pre-exit, right before the exit itself. Unlike many projects I've been a part of in many businesses where you have some amount of kind of ups and downs, ebbs and flows, this was a pretty consistent, steady drumbeat upwards. And so, we had a mixture of actual full-time kind of salaried employees, and then contractor, um, for a number of different reasons based on their geographic locations and so forth. And I think the total was right around 100 when we actually sold, which was February of 2018. So roughly 4-year journey from three to 100.
Nice. That's a pretty fast clip to be hiring up to 100. That's moving. So how did the initial conversation start? with the acquisition or with the exit itself? Because this is a multi-part exit here. So how did it begin?
Yeah, so we started thinking about the idea of an exit in early 2017, actually. And there were probably a handful of different catalysts for that. Um, but when we started that conversation, it was still um, not even, we didn't know we didn't know. So it's kind of, what are we doing here? What's success look like for an exit? And so what we initially did was we kind of reached out to the different bankers we knew, and we reached out to the different possible buyers that we had some connection with, and just started to have conversations. And we had maybe one or two companies that reached out to us as well, but it was not a lot of high quality inbound research. Does that make sense?
Yeah, yeah, that makes sense. So, did you think about hiring a banker? Did you shop around a few times? Since there wasn't that much inbound, did you do your own sort of reach outs, or how did you approach that?
It was not as sophisticated as it probably should have been, in hindsight, and even at the time. I think, at the end of the day, as a first time entrepreneur, you don't know what you don't know, particularly when it comes to how to think about an exit, at least in my experience. And so we had a couple of friends who had been around the investment banking world, and I had done a short tenure as well. And so that part was super fortunate to allow us to kind of reach out and get some perspectives and introductions. So we were able to talk to, I think in hindsight, probably about five different investment banks in various capacities. And that was frankly super helpful to understand, hey, and we, there's a bunch of different criteria people can use when they assess advisors like that, or platforms. We thought a little bit about who actually knows our business well, or not well, who knows this overall ecosystem of, I would call it, digital commerce. And then beyond those two buckets, kind of who do we actually enjoy working with? Because you're, in many cases, as an entrepreneur, going to spend a lot of time with whoever that person is that is helping you with a transaction. And then how do they get along with other stakeholders? In our case, our counsel had actually been with us since 2015. So we felt good about that relationship and wanted to make sure there wasn't some big kind of friction between kind of financial or M&A advisor and legal advisor. So
Mhm.
those were some of the different considerations we had. We didn't do like a hardcore bake off where some of these people, I think, really dig in on, oh, this advisor versus that, or this platform. Ours was a little bit more of, hey, who are we really excited about? What are the kind of viewpoints? Um, and then based on these core criteria, who do we like the most? We probably could have gotten a lower fee, perhaps, if we'd gone with someone different than we did, but that wasn't our number one criteria,
Yeah, yeah. And
for
I
better or
think when it
worse.
comes to comfort level with this type of thing, because a lot of people lose track of you're still running the business, while this is going on. So it's such a like wild mindset that you have to have where one hand's steering the ship and the other one is like talking to a bunch of different people, and it's like a very unique thing. So having someone that's comfortable with, even if it's a higher fee, totally aligns and makes perfect sense. So let's talk a little bit about the deal. Was how long did it take to go through, and how did you guys get a valuation? Was it a multiple on revenue projected, based on your growth? What did that look like?
Yeah, luckily some of this is public, so you can actually kind of triangulate around it. But we started I would call it like the sale process in earnest in probably the middle of the spring of 2017. So when I said we started talking to advisors, the very early stage prep was Jan Feb. But when we think of really, retaining someone, having an agreement, that would be more like April, May. And so really the whole summer was going out there, um, starting to get, a whole kind of packet assembled, a one pager, all this sort of material that you often bring together for a sale. Um, by the time all that material was together, we weren't really talking to buyers until the summer, like the very end of the summer, on into the early fall. And for anyone who's been through this, every deal's a little different, but many of them have some degree of kind of emotional roller coaster where you've got, hey, this person's saying they're really interested, they're talking about this really exciting valuation, and then they go silent, someone else is talking to you, it's a different valuation, all of that kind of up and down. So by the time we actually got into exclusivity, which would be very early 2018 or perhaps very late 2017, we were at roughly like a $27 million revenue run rate, in terms of trailing revenue. So a little higher with growth in the forward look. And then
Hmm.
trailing EBITDA was probably around 10. Um, and so the offer that we ended up accepting, which again is public now, was for 110 million. So basically 11 turns roughly on trailing EBITDA. Clearly a lower multiple when you think about a forward multiple, and about a little over 4 turns on trailing revenue. And I think it was a little bit of both that they looked at for that valuation. I'd say it leaned a little more towards the EBITDA probably than revenue, because we were acquired by, at the time, a public newspaper company, Tribune Publishing. And so I think they were able to kind of get comfortable, given they wanted to invest in digital. They wanted to invest in things that were growing faster than their growth rate. And their growth rate and EBITDA multiple were lower, but I think they believe the market would reward efforts to go with higher growth rate, more digital only, revenue and EBITDA lines.
Got it. Got it. Very cool. And when it came to the team, you were at 100. Obviously, that was a split, as you mentioned, between full time and contractors and everything. So, what happened as the deal went through? Did the whole team go over? Was there an earnout period? What did that look like post close?
Yeah, and to rewind the reel, the structure of the deal, as you had mentioned earlier, the headline numbers versus reality are always filled with nuance. There was three big pieces of nuance with this particular structure. We sold 60% of the company, so we didn't get 110 million. It was 66 million, but
Mhm.
we sold for 50% cash and 50% restricted stock at a certain price point. So there was some cash um, up front, but a lot, again, half was stock in Tribune Publishing, which we couldn't sell for some time. I want to say maybe 6 months to a year, maybe with some tranches. And then another amount of money went into escrow as a holdback. So the actual cash you're getting right away, certainly grateful for it, but in many cases you find it's a lot different than the headline number, and you might have a big tax obligation coming up.
Yep.
um, so in the case of kind of the structure, that remaining 40% was ours as the founders and some key employees. And we had two options. One, in 3 years, we had a put option where we could force them to buy at basically the exact same or roughly the same trailing EBITDA multiple. And they retained a call option where I believe at like year mark 1 or 2, they could call the rest of the business from us.
Mm.
So, a little bit of puts and takes on the earnout structure, and not the traditional either time based or just pure, hey, you hit this revenue target, you get the remainder of money sort of thing. So a little bit different structure. And then when it comes to team, and kind of talent and so forth, we actually retained a large portion. I want to say if anyone departed, it would have been under 5 people, and no key personnel who ended up leaving. It was much more of a, hey, we want to invest in this and see the business grow. And there weren't any like hard feelings about who we were joining. there was some tumultuous activity. If you go back and look, which someone might if they're motivated, you'll see that Tribune sold the LA Times on almost the exact same day. And that was at the
Ooh,
time like the crown jewel asset of Tribune Publishing. So it wasn't without some, I guess, controversy that the deal went down. But it kind of ended up being a strange way, a blessing in disguise. The relative press and scrutiny around our deal was zero because all of kind of reporters covering media focused on the sale of the LA Times to Patrick Soon-Shiong.
nice. I mean, that's wild. That only five people left. That's I think
If
there's
that, if that.
and it's a cool testament to leadership and like being able to articulate what's going on, with a team of 100, taking them into a new, but at the same time, this is unique because it was 60% was the acquisition, and you guys still had some, that 40. So yeah, it's a unique situation, but very cool to know that, 95% of people stayed. That's really, really cool. So, what kind of tips could you give everybody on timing? Because it sounds like you guys timed this really well to get that valuation. You had kind of a unique structure there, on the earn out. But what can you share around timing?
I think the moment when you're like, man, this business is going so well, I'm so excited about stuff, I would really think about if that's the moment to start thinking about a sale, actually. And the reason I say that is when you don't have any reason to sell because you've got kind of leverage and the business is doing well, I think that's when you'll potentially attract the most interesting buyers and potentially the most interesting valuation. If things aren't going well and there's all these problems and revenue and EBITDA are declining, I think that just makes for a tougher climate and you can end up trading for a much lower valuation. So the strangest dynamic exists of you kind of want to be selling when it feels like it's the last thing you should be doing
Mm,
because the business is really humming, you're getting to scale, things are working. Um, Now, it doesn't mean you can't and shouldn't sell in other circumstances. I just think that is a pretty ideal one from having leverage with the buyer universe because your alternative is I just won't sell if the prices aren't what you think they should be. Um, I would say the other opportunity another time is when you have reasons that mean you need to sell. We didn't need to sell, we wanted to, but when you need to, you definitely should, and you should start as early as you possibly can. I have yet to meet anyone who's like, "Oh, I'm so glad that our books weren't in order and our corporate stuff wasn't in order and we didn't keep good records and I'm glad we waited till the last minute to do this sale because it was so much less stressful." That's just not life. The earlier you start, the better. We had about a year to kind of try to get all the ducks in a row for this transaction with best reviews, and we needed all that time, or it would have been a nightmare because to your point, there's not, yeah, you've got advisors, you've got counsel, but it's your business. So who's telling the story and who's being bought? The buyers are buying you to some extent, unless you plan to leave as a part of the sale. So you're going to spend a lot of time, in most cases I've seen, in that sale process as the founder, entrepreneur, owner. And therefore, it's going to be a big commit. And so not only would I start early, but I would communicate to core stakeholders, whether it be team members, family, friends, like you just have to be upfront. This is going to be, an aggressive and tumultuous stretch in most cases.
yeah, well said. I like that. It is. It definitely lands when you say, like, when things are going really well, you kind of think the opposite direction, which is kind of how getting started and everything is. Like when you the things that often you don't think to do turn out sometimes to be the best way to go. So that's a really cool way of looking at it, when things are trending upward and things are going well and you don't think anything could go wrong. I like that. That's sort of what you look at. So that transaction takes place. What happens next? Because I know that there's another exit that takes place. What happens after this one?
Yeah, so it was an interesting saga. I stayed on in a full time capacity for about a year and a half. So if you think of a lot of these situations, particularly with companies that are founder led and driven, joining large organizations, a lot of times founders and key employees are gone, and I've seen as fast as 2 weeks, sometimes a couple months, sometimes like 6 months, a year. Um, I stayed on a year and a half. My other co-founders stayed on, um, you know, the whole duration. But what ended up happening was the business had, ups and downs, which is the nature of many businesses. The pandemic started and had a really strong uptick. And also behind the scenes, or not really behind the front, the ownership of Tribune changed to this hedge fund called Alden Global, which, you can look all this stuff up. It was quite a saga. But at the end of the day, they didn't see best reviews as being a core part of their strategy for Tribune. So they were keen to transact. And that is how we got that kind of final liquidity. We actually sold best reviews along with Tribune. So we sold our 40%, they sold their 60% to a company called Nexstar, which is a publicly traded broadcast TV company. And so that transaction closed the end of 2020 and I think this is publicly available to meaningfully higher revenue and and EBITDA numbers for the business, and the ticker price there I think was 160 million valuation, so a meaningfully higher valuation than the initial transaction. And what was nice is we had this stock story in Tribune, and the stock had also been in a down. I think it got down as low. I think when we maybe had like an $18 valuation ballpark for the stock portion. It got down to maybe like 3 or 4, and then it
Ooh,
came back, and we actually got, I think that maybe the final stock was bought by Alden Global for around 18 or 19. So roughly flat on the stock. And then the remaining portion that we owned became liquid cash, through that Nexstar transaction, which, roughly 3 years after the initial sale.
nice. Yeah, I love this because it's a great example of the complexity behind the headline, of, of just all the different moving parts. And people read the main headline and just assume it's just a handshake and like popping bottles. But I really appreciate all the details and just the level of thought that goes into this, and understanding how all of these pieces move together and being comfortable with it takes immense bandwidth, like just immense amount of effort. At least for people like myself. I mean, I would sit there and just read over it over and over and over again until I was comfortable understanding it. And I think it's really admirable. So I guess the since we've gone through two different exits, you've mentioned a few things around like advisors and attorneys, and we touched on some things around bookkeeping, but what tips can you say around being prepared for entrepreneurs listening to this that are thinking of exiting? What can you share tips wise about how to prepare a business for exit?
Yeah, the big three that would jump out at me, Stephen, that's a great question, are um, the kind of everyone should be doing, but not everyone necessarily is to your point, kind of books, accounting, and legal. And that doesn't mean like having 1,000 lawyers do things. It's just, do you have your corporate documents in order? And if you've created additional operating entities or subsidiaries, is it all kind of cleaned up, buttoned up, well documented in one place? If there's, different shareholders or unit holders with LLCs, kind of having all your ducks in a row with the cap table and those sorts of things is one side. And the other side is just, are you, properly keeping up with books? And there's really two sides, right? Books and accounting can be interrelated, or they can be a little separated, and tax filings, but having all of that kind of consistent on time, no issues with some sort of, tax that you're not paying that someone thinks you should pay. I think that having those lined up. And then the last one that's a little nuanced is just, what is that one pager? Can you pitch your business in, I guess, a sentence or two? And then do you have that one pager kind of core narrative of the business? Those will be the shells in most cases, which you'll build, whatever sort of investor memorandum from. And so I think if you've kept those current, because businesses can evolve and change, that'll really pay dividends in my experience.
Mm, well said. So that takes us to the finale. Knowing what you know now, what would you tell Ben 10 years ago?
I would probably say first and foremost to just kind of like take it one day at a time and realize that there'll continue to be ups and downs. But if you kind of just focus on that long term goal and just take a step forward each day, grow and learn, be good to people, I think a lot of times things do work out.
Hmm. Well said. Yeah, relationships are, they're going to stick and the businesses are going to ebb and flow, come and go. And I think that the relationships in business are pretty fundamental. That's what I've learned as well. So what are you working on today and where can people learn more about it?
Yeah, so we've got to your kind of introduction, we've got Advon Commerce. People can search that one. It's pretty easy to find on Google. Um, Certainly involved with investing with Dynamism Capital, and then we're always looking and thinking about different ways to help different people in the commerce ecosystem. So we've got other ventures moving along, particularly helping those in the Amazon ecosystem, selling products, marketing those products. So I'm pretty findable myself. You can find me on LinkedIn and otherwise, and just encourage people to reach out if there's part of this that you think is of interest or connected to your ventures.
Awesome. Awesome. Well, wherever you guys are listening on iTunes or Spotify, the links that Ben mentioned will be in the show notes. But thank you so much for coming on and sharing your multiple exit stories, Ben.
Thanks, Steve. Really appreciate it.